In today's episode, I'm going to give you the step-by-step guide of how to short as a beginner. Now, it doesn't matter if you're trading stocks, forex, cryptocurrency, or futures. With most financial instruments, you can create a short position if you'd like. And when you are short, you will profit as the price declines. Now, short selling is not a new concept in the market. It's actually been around for over 400 years, and it's allowed investors and traders alike to speculate and profit when they think the price of a financial instrument is going to drop. So let's go ahead and jump into the slide deck, and I'm going to walk you through how this works. When you create a short position, you essentially have a negative position on whatever instrument that you're trading. As you can see right here on Tesla, I have negative 800 shares. This is the exact opposite of what long-term investors like Warren Buffett would do. They buy and then they have a positive position and they'll profit as the price goes up. But when you have a negative position, you profit when the price goes down. So how does that work? Well, it requires understanding a bit of the terminology of short selling. And the first is the concept of borrowing. All right, so what you have to do to create this negative 1,000 share position, just as an example, is you have to borrow these shares from someone who owns them. So you've got your broker here. This is the broker where you're trading. And your broker, of course, has, millions potentially of clients. Now, one of their clients, most likely, is holding shares of whatever you're wanting to short. So this is client number one over here. And let's just say they're holding 1,000 shares of, let's say, GameStop. All right, they're holding 1,000 shares of GameStop. So what the broker does is, because the client is holding those shares with that firm, the broker borrows these shares from that client and lends them to you. You then take those shares and you sell them on the open market. When you press the sell button, you create a negative position. So to create a short position, you can actually just simply press the sell button. When you sell, and since you don't already have a position, your position goes into the negative. Now, this is something that when I was first trading, I had a hard time getting my head around, because sometimes I would buy a stock, let's say 800 shares, and then I'd press the sell order to sell 1,000 shares by accident, and all of a sudden I'd be like, wait, I'm short 200 shares? And it's possible to flip from long to short. So it is something to be careful of, because many people will accidentally begin shorting just because of this ability to flip from long to short. So nonetheless, back to our whiteboard here. You've borrowed the shares from this client. Now, of course, you don't know who that client is or who that customer is. The broker handles all of this on the back end. And what the broker will do is they'll actually give this client a little bit of interest in their account for letting the broker borrow those shares and lend them out to other people. And what you end up paying is a fee. It's called a borrowing fee. And the borrowing fee is what the broker charges you. And of course, they keep a percentage of that for themselves. And then the rest goes to this client right here. So let's say you short a stock at, we'll use easy numbers. Let's just say you short a stock at $10 a share and you short 1,000 shares. You now have a position that is valued at $10,000, right? It's a $10,000 position. So if the price goes down to, let's say, $5 a share, what you have to do is you have to buy back 1,000 shares to give them back to your broker, who's then going to give them back to their client. So you have to buy back 1,000 shares at some point because you've borrowed these, and you can't borrow them indefinitely. So you buy back 1,000 shares, and when you buy 1,000 shares times $5 a share is $5,000. So you buy back for $5,000, you give them to your broker, he gives them back to the client, or she gives them back to the client, and you get the profit of the difference. So the profit of the difference in this example is $5,000. You've made a 50% return in this case. This is a great return on the $10,000 initial position. But let me be perhaps the first to warn you that short selling is a sword that cuts both ways. Because let's just say, for instance, that the price does not go down. And in fact, let's say the price goes up. Let's say the price goes up to $40 a share. Let's say this company, whatever it is, has great news. The price goes up to $40 a share. You're in at 10. So you still have to buy back those shares. You buy them back at 40. That costs you $40,000. $40,000, and you now have lost on this position. And for what it's worth, you've lost more than you could have ever made, because the most you could have ever made is if the stock went to zero. You would have made $10,000. But instead, you turned a $10,000 position into having to buy back 40,000 shares. You've lost 30 grand. That's obviously bad. So this is one of the biggest risks with short selling. You can actually lose an infinite amount of money. And this probably helps you understand why a stock like GameStop cost some of the hedge funds like Melvin Capital billions of dollars in losses, because they created these negative positions to the tune of hundreds of thousands, maybe millions of shares. And then when they had to buy them back at incredibly inflated prices, they locked up massive losses. Now, big firms like that can use different strategies to hedge their bets. And when they hedge, they reduce their downside risk. But for most retail traders like you and I, we're not going to be holding positions long enough to create a hedge, especially if you're day trading. You're just getting in, you're getting out, you're getting in, you're getting out. But it's definitely important to be aware of the fact that with short selling, you do have the potential to lose far more than you can gain. So it is a risky strategy, far riskier than buying to the long side. Let's talk about a few of the other terms around short selling. Okay, so we already talked about borrowing. Borrowing is when you borrow, and we talked about the borrowing fee that your broker will charge you. These fees, by the way, are charged on a per day basis. So each day that you continue to hold this position, you're going to have to pay your broker that fee. Now, a common fee is 10 cents per share. So 10 cents per share with 1,000 shares, you're going to be paying $100 per day to borrow this stock, let's just say. And so, if you're holding it for 10 days, 15 days, 20 days, all of a sudden you're spending $2,000, $3,000 on borrowing fees. Well, how much do you really stand to gain? If you spend 20% of the potential profit on borrowing fees, then that starts to not work. But for active day trading, if you borrow and it's just for one day, then you'd pay $100. And if you can get this kind of move here from 10 down to 5 in one day, then $5,000 of profit versus $100 in borrowing fees, that's an equation that most people are going to be pretty comfortable with. But something that's interesting to know is that there are some stocks where you actually don't have to pay a borrowing fee. Those stocks are called easy to borrow. Now, an easy to borrow stock will typically have an E with a green on. It's an E that's in green right here. That marker's gone. That's okay. Or it says ETB, easy to borrow. Either of these two phrases indicate that the stock is easy to borrow. And when a stock is easy to borrow, your broker has so many clients that have shares of it, they can get shares and lend them out to you, and they don't make you pay a borrowing fee. Now, why would they not make you pay a borrowing fee? Remember, your broker makes money when you trade. They want to encourage you to trade a lot. So they're only going to charge you a fee, the borrowing fee, when the shares are particularly hard to come by. When they're hard to borrow, they're going to start charging people fees. But when they're easy to borrow and there's lots of shares available, they'll make them easy for you to trade, no fees. So stocks typically that are easy to borrow will be large cap stocks. Certainly an index like the S&P 500, easy to borrow. Stocks like Ford, Bank of America, General Electric, these are easy to borrow. Tesla, Netflix, easy to borrow. They're big companies, Meta, Facebook, easy to borrow. Stocks that are going to be harder to borrow are going to be usually small cap stocks. GameStop during the initial move in 2021 was hard to borrow. It became easy to borrow in 2024. A lot of small cap stocks that have the potential to go up 200, 300, 400% in one day are very hard to borrow. And you could end up paying as much as $1 per share, which means if you want to borrow 1,000 shares, you actually have to pay $1,000 in borrowing fees, which is kind of absurd at a certain point. So the cost to borrow is definitely a challenge. Now, we've got the term of borrowing, and we've got easy to borrow, and then we have what's called hard to borrow. So if a stock is hard to borrow, then what it means is that your broker has to go look for shares. And so on my platform, hard to borrow is going to have an L, which stands for locate. Locate. Sometimes it's hard to write while I'm talking. All right, so locate. L for locate. That's going to show that this is a stock that is hard to borrow. So the broker at that point can then go try to locate shares for you. And in my platform, I actually have a window that is it's a locate window. So you type in the stock, you press search, and the broker will search digitally and then comes back and tells you, yep, I can find the shares and this is how much they cost. Do you want them? And you can click yes, I accept, I'll pay that borrowing fee, or no, I don't want it. So let's say you accept the borrowing fee and you create this negative position. All right, so we'll go back to our example here. You've created a negative position. All right, so you borrowed the stock, you created a negative position of 1,000 shares. You hold it, whatever it is, you're in at $10 a share. You buy back at, let's say, $7 a share. I'll do 7 right there, that's fine. So in this case right here, when you buy back, this is called covering. So you're covering your short position, right? So you're buying back the shares. So the concept of covering is just to replace the shares that you already borrowed. So in the case of the relationship with the broker here, when you cover, they then give the shares back to the original person that they lent it from. And, although this is all in a very digital market, they do have to be able to account for what happens to these shares. We, during 2021, heard a lot about the concept of naked short selling. And naked short selling refers to the practice where the broker gives you shares to short without first borrowing them from anyone. And that there's apparently there was an override key. They would press F1 and they would say, they couldn't find shares, but they had reason to believe they were available. So basically, someone would say, I want to borrow shares, and they couldn't find the shares in the moment, but they had reason to believe they were available. So they'd press the F1 key. They'd give that client the shares that they wanted so they could short it, and then they'd go find the shares later. But what we ended up finding out was that, in fact, a lot of times they don't end up finding the shares later. So they just let you basically short a stock. And the problem with this is that if you let a lot of people sell and it's not based on another person's position, you could actually have more selling volume than there is buyers in the market. And what that can do is it can create a stock to drop significantly because it creates an imbalance to the sell side that's unnatural. So this practice of naked short selling is illegal. Brokers are not allowed to do it, but as we know, brokers, some of them motivated by money and encouraging their clients to just trade actively and their traders to be very active, created this override button. So there have been a number of fines related to this practice. It's supposedly cleaned up, but it may still continue to happen. Now, for you as a regular retail trader, you're not in the loop of what your broker is doing to get these shares available to you. So you don't have to worry. If your broker's doing something, it's the broker that would get fined. It wouldn't be you individually, because we as retail traders, when we press the locate button to borrow shares, we don't know where they come from, right? We just assume that the broker's doing it the right way. And most likely they are, but I just thought I'd mention it since it's sort of on the topic. So the concept of short selling in this scenario here really is quite simple. The areas where it gets risky is when you're shorting something that has the potential to go, well, we would say parabolic. And so I'm going to show you an example here of a couple of charts that I think will just help highlight the risk of short selling. Now, hey, by the way, if you want to learn more about the strategy that I do trade every single day, you could download my small account strategy PDF. It's going to be pinned at the top of the comments, linked in the description. And this is something you can implement in your own trading. As always, I encourage you to practice in a simulator before you trade real money, but you can learn more about the strategy that I'm trading every single day. Something that a lot of short sellers will do is they will short stocks as they are moving higher. So essentially, if you have something that is moving up very quickly, which is common in volatile markets, you'll see the candles are squeezing up higher and higher and higher. We know that we're getting really extended. And so what short sellers will often do is they'll take a starter into these positions, into this move higher. So they'll short a little here, a little bit more here, a little bit more here, a little bit more here. And the reason they're doing that is because they know that when stocks get really extended like this, often they'll sort of have this final top and then they'll have a big drop. And if you wait for this moment to take your position, you might not get filled till like down here, and then you end up missing a lot of the profit because these are the spots where they want to be buying to cover some of the position for a profit. So the practice of shorting into strength is very common. Now, Inversely, there are people who trade to the long side who will buy into weakness. So either buying down here or the sort of exactly inverse chart of something that's been declining for a long time and they're buying for the reversal. Now, I'm not personally a big fan of reversal trading because I find it a lot easier to trade with a existing trend, buying pullbacks and riding momentum higher, than to try to predict a reversal. But nonetheless, this is a popular strategy that a lot of short sellers engage in. And it works and works and works until it doesn't. So this is an example of a stock that literally went from $20 a share to over $2,500 a share, which is an insane move. A 5,000 share short position would have produced a loss of $12.5 million. Just a 10,000 share short position could have produced a loss of $25 million. So one of the things that I am a firm believer in is that I never want to empower one trade to end my career ever. And so for that reason, I do not short stocks. That's not my practice. It's not my strategy because I feel like the risk is simply too high. Now you can argue, well, look, you can use a stop loss. You can control your losses with stops. And while that's true, what we also know is that brokers will auto liquidate you if your account exceeds the amount that's in your balance. And they can also auto liquidate you if the original client asks to redeem their shares, which means you could get pulled out of position and forced to close it. Now, as we know, GameStop resulted in Melvin Capital losing $6.8 billion. This is an incredible amount of money to lose. So just because there's institutional traders that have a lot of experience, they're not immune to this happening to them. So waiting for the reverse to begin to me feels safer, but that does mean chasing a little bit of a drop and potentially dealing with what's called short sale restriction. Now, I'll talk about short sale restriction in just a moment, but I want to show you another example here of a stock that was declining, selling off. It dropped from $30 a share all the way down to $12, which was really incredible. And so if you were shorting this and you had a position on this, the short side, you would have been up potentially with 5,000 shares, 50 grand, 60 grand, maybe 75 grand, depending on what your average was. Could have been a huge winner. And then all of a sudden the stock bounces up to $12.50 and opens at 25 and is halted up. A halt up occurs when there's more buyers than sellers. Well, what ended up happening on this stock was it resumed at $500 a share. This is unthinkable. Almost a glitch in the market. But in a stock market, there are no refunds. And if you took a 5,000 share position, you could have had an instant $2.4 million loss. 10,000 shares, $4.8 million loss. So the realization, I share this with you because I want you to understand the very real risk of shorting stocks. Now, you can try to short safely, and there's certain stocks that are going to be safer than others, but just don't lose sight of the fact that shorting is a risky strategy. In fact, it requires you to have a margin agreement with your broker. A margin agreement states that if you lose money, you will pay the broker back. And so if you lose $2.5 million, you're now on the hook to your broker. And that's a really scary thing. And I would never want to see that happen to any trader. So short selling, it's a practice that's been around for a long time, but it's also led to the demise of many traders far bigger than yourself, far bigger than me. In fact, the demise of large hedge funds. So trade cautiously, manage your risk. And as always, if you enjoyed this episode, I hope you hit that thumbs up. And I hope you subscribe. And I'll see you for the next one real soon.